Today's topic, 5 common tax mistakes. And as you know, it'll be geared more towards physicians and other high-income professionals, but you could argue that this topic is transferable to anyone, that files taxes, just probably to varying degrees. And I am going to use more live case studies, so as we continue to get great feedback on those videos, I'm going to jump in to some screen share, walking through some tax planning software, but we're going to walk through everything from retirement plan contributions to charitable giving, to 529 plans, to HSAs, and then the one dark horse, not thinking about future tax planning with the retirement savings. So that's going to be our number 5. It's going to add in a little mix in there. So we're going to cover all that. We're going to do a live case study. Stay tuned. That's all coming up next. Okay, the first tax mistake, not maximizing your retirement plan. This is low-hanging fruit. This is the easy one. And this is as simple as saying, okay, you could have put in $23,000 to your 401k or 403b, but you didn't, or a larger amount. Technically, you can go the whole way up to $69,000. I'll cover that in a second. But let me share my screen here and let me walk through why this is such an important topic of really leaving money on the table. So let me share my screen. So here we go. So tax planning software is up. This is a sample client. Think of them as a dual physician household. Total household income is around $687. There was income, and then we had some interest and dividends, some things trickled in there. But here's what I want to show you. Now, I have a few different examples here as we walk through today's video. There's a few different things I want to jump into. But for right now, let's just focus on scenario 2 and scenario 4. I got this HSA one in the middle, but I'm going to get to that one next. Here's why it's important. Scenario 1 is you don't do anything to your retirement plan, right? Just forgot about it. You completely missed the ball on it. Scenario 2 says, oh, you remembered it, but you put in $23,000. So I listed it here. Now, remember, if you're doing this to an employer plan, technically it's actually going to lower your income number. Your W-2 is actually going to be lower. But for illustration purposes, I wanted to list it here. So I actually listed it as a self-employed plan. It does the same thing. It's an above-the-line deduction. It's lowering your AGI. So here we have that number now dropping into 664 compared to 687. So that is saying, hey, we lowered your income. Now, you don't care about that. You just want to say, all right, well, how much money did I save? Well, here you can see, right? So your total tax went from about 175 to about 167. And if you're doing the math at home, as I had to write down, but I realized that's actually pretty easy math, that's $8,000. So by you putting $23,000 at these tax rates, right, your marginal bracket here for our sample clients is 35, their effective is 26. That is an $8,000 savings on a $23,000 investment to their retirement. Easy tax savings. Now, $23,000 is a good chunk of change, but you're maxing out your 401k, your 403b there. But that is what we mean by just missing that low-hanging fruit. And then what I did over here, if you scoot over to scenario 4, this column here, I'm going to skip this HSA one. Now, in defense of scenario 4, I also assume they're going to max out their HSA. But just roll with me here for a bit. If we scroll down here, now they are putting in $69,000. So that's the max. They're either going to be a partner in a firm or they have 1099 income, right? It's hard to really control that number if you're working at an academic hospital, right? You can get in your $23,000, but we don't know what the match is. In this example, we're just saying maybe it was all 1099 income and they actually put in $69,000 to their solo, okay, right? They really loaded that thing up and they had an HSA. But now all of a sudden, now look at their total tax. Drops down to 147. And we can see their actual effective tax rate dropped as well. So in this example, we are now at a total savings of $27,000. So by them getting the $69,000 into a retirement plan, them also getting the $8,300 into the HSA, I'm going to have a whole nother story on HSAs next. They were able to get that tax bill lower by $27,000. Again, easy tax fixes here. And this is why we're calling this video common tax mistakes, is because that is an easy one. If you're missing the full max on a 401k or 403b, maybe you even have a 457b you can add in there. Or if you're 1099 income, you can start to maybe even think about adding a defined benefit plan in there, a cash balance plan. You have a chance to really crank away money on a pre-tax basis to lower that tax bill. So first one we wanted to cover is that missed opportunity in the retirement plans. Next up, missed charitable giving. Whether you're already doing charitable giving, but maybe not documented properly, Or you're doing charitable giving, but you don't actually know how it factors into your taxes, which that one is extremely common. We had a great video that we released before. If you just go look through our history, look for the DAF, the Donor Advised Fund, where I actually will walk through the Schedule A. I'm not going to go through it in that level of detail for this video, but I am going to share my screen again to show you what we're referring to. But the key is you got to track your charitable contributions, right? If you're writing a check to a charity, make sure you're tracking it. If you're taking clothes by, the bag load over to Goodwill, make sure you're tracking it, make sure you're using their pricing guide, but make sure you're following all the rules. Now, I'm going to share my screen again. And the main thing to keep an eye on here is itemized versus standard. Now, all these will look the same. We use these sample clients before for that donor advised post as well to show the benefits of how you really break down the Schedule A and the charitable giving. So in this example, the only deductions they're getting are their SALT, which is state and local taxes. Unfortunately, everyone's capped at $10,000 there. That is a real pain in the butt for physicians. I always say that that's one of the biggest changes to the tax code that I don't think many people understand how that affects them, but that's a big one, especially for high income households. So that's getting capped out at $10,000. And then you also, I'm putting a mortgage interest expense at 28. So I'm sorry, 18, and then 10 plus 18 is 28. So you're at 28 there. So in this example, this client would always take the standard deduction. But if they were tracking charitable giving, they're so close now that pretty much any type of charitable giving will put them into the itemized deduction. So that would be a big benefit for them. Another thing to keep in mind is with that donor advised fund, again, kind of going back to that video, but if you are used to giving to charitable organizations, every single year, maybe think about bunching contributions. So instead of maybe doing 10,000, maybe you do 20,000 in one given year. Because in this example, it'll really push you above those limits. So you'll get a much better number in there. And then the one thing I always note too is if your itemized deductions are low, so let's just say you don't have a mortgage interest expense. Say you're renting, right? So you only are getting this 10,000 from SALT. And for easy math for me, just keep it simple. Let's just say the standard deduction is at 29,000. You have $19,000 to make up for before you even get into itemized. So in that example, if you wrote a $20,000 check to a charity, you only increased your deduction by $1,000 because 20,000 plus 10,000 gives us 30, right? But regardless, you were already on track for the standard at 29 in our example. In a way, I don't want to say you wasted it because again, we don't give the charity just for the tax benefit, just a nice side benefit, right? You missed out on 19,000 there because of that breakdown on what we were already missing in the standard deduction. So keep that in mind. That's the one that's missed the most, where clients are giving to charity. They assume that it's benefiting them, but then we walk through and we're like, well, you've been taking the standard deduction for years. You're not going above that number high enough. And there's other ways to work in a donor advised fund, but keep that in mind. But the second most common tax mistake that we see with our physicians and most commonly missed is not tracking or not understanding the charitable giving benefits when it comes time to the tax implications of those contributions. Next up, the health savings account, the HSA, another low-hanging fruit. Now, there are some rules here, right? You can't just say, it's not just like your 401k, we're like, hey, I'm going to throw money into it. To utilize an HSA, you have to have an HSA eligible health plan, a high deductible health plan, and not only high deductible health plan, but a high deductible health plan that is also HSA eligible. Now, most high deductible plans are. The only time we really see this get a little bit wonky is if you're buying your plan through the exchange because they can't understand the credits that you may have been receiving. So sometimes you'll have a high deductible health plan through the exchange that's actually not HSA eligible. So just kind of keep an eye out for that. But for the most part, if you have a high deductible health plan, it's likely HSA eligible. If you're uncertain, just check with HR. But the beauty of the HSA is it is a pre-tax benefit. It also grows tax deferred. And then assuming you take it out for healthcare expenses, it's completely tax free. So this is why you always hear the HSA has this triple tax benefit. So it's a wonderful account. And ideally, as a high income physician, you are going to put money into this account. You can get it invested outside of HSA, but you're going to get it invested. You're going to let it grow and you're not going to use it for a very long time, right? You're going to let compounding interest do its thing. Now you're probably sitting there thinking, well, what do I do when I have a medical bill? You're doing pretty good in life, right? Pay it out of pocket. Try to pay those expenses out of pocket. And then that way you can allow your HSA to really grow up. So as we get older, and unfortunately, those health bills are probably going up, we have a nice nest egg there to pay those. And then if you always want to use the secret weapon, just save all your medical receipts too. So if you don't want to use it for healthcare, you just want to take a crazy trip to Hawaii and you have $20,000 in healthcare receipts over the last 10 years, boom, there you go. Enjoy the trip. So HSA, let me share my screen again to show you what an HSA can do to your savings. So scenario 3. So we are now live in scenario 3. Now, what I want you to look at here is just take scenario 3 versus scenario 1. That is our main goal here. We did not add, no, we do have it in here. Okay, so we have this one has the 401k contribution. We're going to kick out this 401k. We're just going to see apples to apples. So let's delete that. So now what I want to show you is just, okay, you were in track for no HSA, no 401k plan. But now in this example, you're only going to do the HSA. And that's the current limit for married, I shouldn't say marriage, say a family plan. If you're an individual, $4,150. Take that number in half. But if we scoot down here, we'll see total tax bill down here. So you get about $3,000 in savings. Put in $8,300, get about $3,000 tax savings. So we're really comparing this 174 to this 172 number. I should say 175 to 172. So the HSA is a good tax savings. Again, low-hanging fruit, but you have to be an HSA eligible plan. Triple tax benefits, really neat tool. Put the money in there. Try not to use it. Get it invested. Let it compound. Decades is what we're looking for. But easy tax fix here on a very common tax mistake. Don't miss out on that HSA. Number 4, the 529 plan, which this one I debated if I wanted to put into it because no matter how much money you make, the 529 plan isn't a significant tax break. And it's not a federal tax break. It's a state tax break. And not all states offer it. Some states just don't offer it outright, like a California. Some states don't have income taxes, like a Florida, right? So there's no income tax deduction there because, well, we don't have state taxes. Some states offer a credit. Credits are more powerful than deductions. What does that mean? If your state offers a $500 credit, that is a dollar for dollar reduction in your state tax bill. That is more powerful than a deduction. So just remember that. And if you're asking, states that offer that are Indiana, Oregon, Utah, and Vermont offer tax credits. So not just the deduction, but a tax credit. So very powerful there. So when we come back, I'm going to once again share my screen. We use New York because I wanted to get a higher tax state. Scenario 5. This one, we're mimicking what we were doing on 2024, just straight up. So the only difference between scenario 1 and scenario 5 is the 529 plan. In the state of New York, it's a $10,000 married filing jointly limit. So I'm going to scroll down here so I can show you. So you can see only one column, 10,000. Put it right here. We did not have it over here in scenario 1. Everything else holds true. We keep everything else the same. We're just looking for a true comparison. So what happened? We're going to assume that they're not a New York City resident. We're just going to say they live in the state of New York. Say they live over in Syracuse, right? Give a shout out to the orange over there. So we were on track to pay $45,823. Well, with our $10,000 529 plan contribution, we lowered that by about 700 buckaroos. So not a massive savings, but if you're a high income professional, I don't think you're going to be mad at me if you save $700. So that's why there are tax benefits, but you have to know your state's rules, but they can be a tax help. It's one of those ones where it's not going to be, a huge, I just saved $10,000 in taxes like we were seeing there, with the 401ks and the HSAs. So 529 plans, check your state's rules. See if you will get a good credit out of it. Again, some states have those credits in there and then deductions. And if they have deductions, try to take advantage of that. Use your state's plan. Most states require to use that. Pennsylvania is one of those unique ones. There's a few others with Pennsylvania as well, where you can actually use any state's plan and still get the tax deduction. So check out the 529 plan. Some good tax benefits in there for you. Last but not least, invest thinking about future tax bills. And I know that may sound a little bit difficult to comprehend, but really the main thing we're looking at here is really the Roth IRA. And in particular, for high income professionals, you're likely only looking towards that backdoor Roth IRA. And the reason why we love that backdoor Roth IRA is it's tax neutral. You are making a non-deductible contribution to an IRA. You're going to let those funds settle. Some experts say you can do it the next day. Some say wait a month. We're in the month group. Some will say wait a quarter. Some will say wait a year. Give it a little bit of time in there and then convert it to your Roth. Once it's in your Roth, don't forget to invest it. Just because it's in a Roth doesn't mean a magical unicorn will come in and invest it. You still have to invest those funds. So don't miss out on that very important step there. But in this example, the reason why we love the backdoor Roth is you didn't waste anything. It was tax neutral. You did not give up any pre-tax benefits. And pre-tax benefits are high, right? Because we just said, we're looking at that example, we were in the 35% marginal. The effective rate was, in the high 20s. Important numbers there because in that example, we don't really want to give up too many pre-tax deductions. And that's why from our side of it, from our planning firm, we always try to maximize all of our pre-tax deductions. We always want to get a backdoor Roth in there. And we know there will be this beautiful time between retirement and RMDs, which stands for required minimum distributions where we can start to do Roth conversions and we can start to try to make those buckets even. But in a perfect world, if you could retire, you'd have an equal amount in pre-tax dollars, an equal amount in Roth dollars, and an equal amount in a taxable account, your traditional brokerage account, a third, a third, a third. It never works out that way, but that would be great because then we have all these buckets to choose from based on the tax laws, the tax code, the tax percentages at that time. So just keep that in mind that when you're investing, still be thinking about future tax rates because we don't know what they're going to be. If they knew what they were, I could easily tell you, should you do a Roth or not do a Roth, but we don't know that. So just understanding that you're trying to build tax efficiency for many decades down the road, keep in mind really those buckets, right? Pre-tax, Roth, brokerage, we'll call it a taxable account. Keep that in mind as you're investing. Also be thinking towards the future. And there you have it. 5 common tax mistakes and really simple ways to fix it. Walking through all those retirement plans, low-hanging fruit. HSA, if the plan is eligible, if you're eligible for that plan, low-hanging fruit. Charity, just understand what's going on there, right? That can go a really long way in your giving. 529 plans, if that makes sense for your situation, if your state has tax benefits, and then also thinking about that longer term outlook on how you're investing into those buckets. Thanks for hanging out with me for the last 15 minutes or so. If you have not subscribed, now's a great time to subscribe to the channel. Click on the bell icon. You'll get a notification every time we release a new video. We are now up to weekly updates on the YouTube channel. Thanks to your viewership, the questions we're getting, the increased viewership, and even all of our followers, we are now coming at you weekly. If you have ideas for content, either drop me a comment or even in our notes section there, you can even go into our Google form and send us an idea. As you have probably seen in past videos, we will always pull that content to try to put a fresh video out there for you. So again, thanks for hanging out with me. And as always, catch you on the next video.